Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Okta. Okta is an identity platform and it has done tremendously well to move its customer base beyond single sign-on, its flagship product. And its guidance is particularly attractive. It's guiding to grow at approximately 35% compounded over the next several years. So that's on the front of it is really, really attractive. But as we go through and analyze its prospects, I question whether there's enough upside for new investors coming to the stock right now and paying approximately 18 times forward sales. So Okta's actually, compared to other tech names, particularly cybersecurity names, Okta's done really, really well. The stock is only down approximately 30% in the last several months. Compared to other tech names, it's been really, really resilient. And I mean, I don't understand why. You know, I don't think that there's enough here to say that this is a particularly outstandishly gold mine to really kind of to substantiate it not selling off. But the market has spoken, and yeah, so everything has kind of calmed down slightly. And there's so much opportunity out there right now. Early February, we're going into Q4 season for a lot of the a lot of the medium caps. So in that context, I think that yeah, there's so much of a buyer's market. I'm kind of interested that this hasn't kind of people haven't sold off more to kind of rotate into other names. Anyway, so as we go and go through here, so they report their Q4 2022 results in March. Remember, their fiscal year and the calendar year misaligned. So I'm just going to talk about the fiscal year here. So Okta made the acquisition of Auth0, and that acquisition happened in May. So until we come around to Q2 23, until we lap that quarter, which is Q2 of 22 last year, until we lap that quarter, we're not going to be able to really see what the organic growth rate is here. The one thing that I have a question mark is they're guiding, they came out very aggressively and they guided straight away on the back of Q3 22, kind of get my quarters misaligned here. Q3 22, they gave the guidance for investors straight away. We're going to grow next year by 37% year over year. So right away that they're going to come out at 40 or higher. Okay, so we're all kind of on the same page here. But this, you got a very easy comp of Q1. So once they get past the easy comp of Q1, I suspect they'll probably grow at, let's say, mid-50s in Q1, because obviously they got that acquisition of Auth0 that I already discussed. Once we get past that, the remainder quarter is going to come up against really heavy comps, particularly with Q3. So it's going to be a tough game for them. And if they guide to grow approximately, let's say, 40%, that implies that the second half of the year is probably going to go. So just something for you to kind of bear in mind. Now, what else do I want to highlight here? So what did they actually do? So Okta has an amazing platform, right? So it's about allowing access to the technology to the right people. So it has two kind of revenue streams. Most of what it does is enterprise based, okay? So rather than giving a firewall to an enterprise, you use the single sign-on product. And what it does is it stays above the cloud so that you can kind of just access that all your kind of applications through the Okta platform. So rather than kind of sign into Salesforce, sign into Zoom, sign into this, sign into that, you just kind of sign in at the top and then you're kind of inside. So in that context, what it does particularly well is it solves a problem. So it offers the cybersecurity element to it, but it also solves the problem of hassle. So then they made the acquisition of Auth0. So Auth0 is much more consumer-facing apps, okay? But this is going to allow them to broaden the reach, to go beyond just say facing US businesses and really kind of go much more of a global scale. So this is what ultimately needs to happen, because you need to have that kind of global reach if you're going to justify the whole value proposition of it. So what they're trying to do is replace the legacy identity access management infrastructure that companies have. So by taking it from on-premise to the cloud is really the driving force here, is the driving force of Okta's identity cloud. So Now, let's just discuss here. I know that there's a lot of different kind of figures and it looks a bit blurry, but I'm just going to kind of run through and highlight what you need to know here. So, the profit margins for Okta appear to be moving in the wrong direction. So, Q3 21, so remember the fiscal years misaligned. So, Q3 21, which was last year, they had approximately non-GAAP operating margins of 2.5%. Okay, well, 2.5%. Fair enough. Then Q3 22, which is this time around, they had negative 2.7%. But of the negative 2.7%, this is a non-GAAP margin, okay? So they've added back the stock-based compensation, they've added back amortization of intangibles. Now, the stock-based compensation is increasing rapidly. And the amortization of intangibles, although smaller in value, are also increasing. I'm not even going to discuss the charitable donations, okay? Now, what you have to bear in mind is that at present, approximately 60% of Okta's gross profit margins are being added back as stock-based compensation. To put this in another perspective, out of every dollar of gross profits that the business has, approximately 60% is stock-based compensation that gets added back to management, as stock. So the more it grows, you should be seeing the business becoming more and more profitable, but it doesn't appear to be the case even on the non-GAAP basis where everything is added back. So it's kind of just something that I wanted to highlight for you. So once we look towards Q4, so Q4 is expected to be negative 9%. So again, it shows that despite them growing at a rapid rate, their ability to be prudent on the bottom line isn't really working out for them. So here's the context, right? For Okta, by my estimates, Okta's organic growth of 35% year over year has been accompanied by an 18% growth in shares outstanding. So it's not the worst case of in tech, it's not the most shocking case, but you're still nevertheless seeing that a large portion of the growth, organic growth that they're putting out there is being, diluted out by 18% year over year in the number of shares outstanding. So the number of shares outstanding, they tell you that it's going to exit Q4 with 154 million. So you're not really getting that much of a return on investment as a shareholder here. Now, the share price is priced at approximately 18 times forward sales. So it's not as expensive as it once was. But on the other side of the equation, shares don't trade in a vacuum, and you got many other SaaS businesses that are priced at below 15 times forward sales that are either very close to break even or already non-GAAP profitable. So why would anyone kind of really be so compelled to pay 18 times forward sales? I'm not talking about the people that are already kind of bought the shares and they're fully entrenched and committed and all that, like buy and hold forever. But I'm talking about like new investor kind of looking at this and kind of thinking to themselves, I've got fresh capital, what am I going to buy? And with the fallout of so many stocks being in the bargain basement right now, I think it's difficult to see how this is going to be particularly compelling. So anyway, just before we wrap up, so if you want to find out the names that I'm particularly compelled towards and particularly attracted towards, don't forget to check out my marketplace. It's called Deep Value Returns. You can see the name there above the screen. Yeah, so come on board, drop me a line, look at what other people said, check out the reviews from my marketplace on Seeking Alpha, okay? Thank you so much, good luck for the earnings season, and I'll see you soon.